Imagine waking up one morning and discovering that everything around you has changed in price. Your morning coffee costs twice as much. Your rent has increased by 30%. Fuel prices have jumped dramatically. You might ask yourself, are things really getting more expensive or is it just by imagination? Economists faced this exact problem hundreds of years ago. They needed a way to measure how prices change over time, but comparing thousands of prices individually is nearly impossible. So, statisticians created a powerful tool: index numbers. An index number condenses huge amounts of economic data into a single number that tells us whether things are rising, falling, or staying stable. This simple concept helps governments measure inflation, business plan investments, and central banks decide interest rates. In today's lecture, we will explore index numbers from the ground up, starting from basic ideas and progressing to advanced economic applications used by modern financial institutions. By the end of this lecture series, you will understand how index numbers are constructed, why different index formulas exist, how economists measure inflation, how stock market indices work, why Fisher's ideal index is considered ideal, and most importantly, how these numbers influence real economic decisions. Let's begin with the simplest question: what exactly is an index number? An index number is a statistical measure used to represent the relative change in a variable across time, location, or categories. Instead of examining individual numbers separately, we compress the information into a single indicator. Let's understand this with a simple example. Suppose in the year 2020 a basket of groceries cost 1000 rupees. Now imagine that in 2025 the same basket costs 1250 rupees. Rather than reporting the absolute change every time, economists express this change using an index. We set the base year, in this case 2020, equal to 100. Then we compute the index value for 2025. So formula is index number equaled current number by base value multiply 100. So in our example, index equaled 1250 by 1000 multiply 100. Index will be 125. This tells us that prices increased 25% relative to the base year. This is the essence of index numbers. They convert raw data into relative comparisons. This method allows economists to compare different time periods, different regions, different industries without being overwhelmed by raw data. Index numbers play a crucial role in economics, finance, and statistics. First, they simplify large volumes of data. Consider the thousands of goods sold in a modern economy. Tracking the price of each product individually would be impossible. Index numbers allow us to summarize all those changes in a single figure. Second, index numbers help identify economic trends. For example, rising price indices indicate inflation. Falling price indices indicate deflation. Stable indices suggest economic balance. Third, index numbers act as economic indicators used by policymakers. Central banks monitor price indices carefully. If inflation rises too quickly, they may increase interest rates. If inflation falls too low, they may reduce interest rates to stimulate spending. Index numbers also influence business decisions. Companies analyze price and production indices to forecast demand and plan production levels. Investors use stock market indices to evaluate overall market performance. Without index numbers, interpreting economic data would be extremely difficult. Index numbers are everywhere in modern economic life. One of the most famous examples is the Consumer Price Index, often called the CPI. The CPI measures changes in the price of a basket of goods and services purchased by households. In the CPI rises from 100 to 150, it means the general price level increased by 50% compared to the base year. Another example is the stock market index. Stock indices track the performance of a group of companies. For instance, the Nifty 50 index in India reflects the performance of 50 major companies listed on the stock exchange. These indices allow investors to understand whether the market is rising or falling. Index numbers are also used to measure production. The Industrial Production Index tracks changes in manufacturing output. Governments rely on such indices to assess economic growth. Finally, we have the Cost of Living Index, which compares the cost of living between cities or countries. For example, living in Mumbai may require a higher income than living in a smaller city because the cost of housing and services is higher. All these measurements rely on the same fundamental concept, index numbers. So far we have discussed index numbers in general terms, but economists actually classify index numbers into several different categories. Each category measures a different type of economic change. Some indices measure price changes, others measure changes in quantities produced or consumed, and some combine both price and quantity to measure overall value. Understanding these categories is essential because different economic questions require different types of indices. For example, if we want to measure inflation, we use price index numbers. If we want to track production growth, we use quantity index numbers. If we want to measure total revenue or output, we use value index numbers. In the next section, we will explore these types in detail. Price index numbers measure how the prices of goods and services change over time. They are among the most widely used indices in economics. The basic formula for a price index is price index equal to cost of basket in current period by cost of basket in base period multiply 100. The key idea is the basket of goods. Economists select a representative set of products that people commonly buy. This basket might include items such as food, clothing, housing, transportation, healthcare. By tracking how the cost of this basket changes over time, economists estimate how the general price level changes. Examples of price indices include consumer price index, producer price index, wholesale price index. These indices help governments measure inflation and adjust economic policies. While price indices measure price changes, quantity index numbers measure changes in production or consumption levels. For example, if a factory produced 1000 cars in 2020 and 1500 cars in 2025, we can calculate a quantity index. Quantity index equal to current quantity by base quantity multiply 100. Using our example, quantity index equal to 1500 by 1000 multiply 100 equal to 150. This means production increased by 50% relative to the base year. Quantity indices are widely used in measuring industrial output, agricultural production, and international trade volumes. Finally, we have value index numbers. Value indices measure the change in total value, which combines both price and quantity. Value equal price multiply quantity. The formula becomes value index equal to total value in current period by total value in base period multiply 100. This type of index is useful when we want to analyze overall economic performance. For example, a country's export value might increase because prices increased, quantities increased, or both. Value indices capture the combined effect, and increasingly there is a mathematical relationship. Value index equal to price index multiply quantity index. This relationship helps economists separate price changes from quantity changes when analyzing economic data.